Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone.
Glad to be here.
Yeah, we are really thrilled to have you joining us for today's deep dive. And our mission this morning is to help you decode what is honestly, without a doubt, one of the most chaotic and fast-moving news cycles we've encountered in a very long time.
Oh, absolutely. It's moving incredibly fast.
Right. We're looking at this unique moment where an escalating global conflict is colliding head-on with, your personal portfolio, the tech tools you interact with every single day, and the global supply chains that dictate the pricing models of basically everything you buy.
Everything from gas to sneakers.
Exactly. So to do this properly, we've pulled together a massive stack of reporting from across the financial media landscape. The insights we are unpacking today are drawn directly from the latest on-the-ground reporting and market data provided by CNBC, Reuters, Bloomberg, Fortune, and Yahoo Finance.
And look, before we jump into that first major thread, it is critical to state something right at the top of this discussion.
Yeah, please do.
The sources we are analyzing today cover highly sensitive, politically charged, and active military conflicts involving the United States, Israel, and Iran. I really want to assure you, the listener, that this deep dive will never take sides or endorse any political or geopolitical viewpoints.
Never.
Right. Our sole purpose today is to impartially report and analyze the facts, the data, and the real-time market reactions exactly as they are contained in our source material. We are just here to help you understand the economic and technological ripple effects sweeping through the markets. Nothing more and nothing less.
I appreciate you laying that groundwork. We are entirely focused on the mechanics of the markets and what the headlines are signaling to investors. So here is the roadmap for how we're going to navigate all of this incoming data today. We have three main pillars to get through.
Three big ones.
First, we are looking at the massive macroeconomic shockwaves rippling out from the escalating U.S.-Iran conflict. Second, we're pivoting to a stunning tech sector backlash involving OpenAI, the Pentagon, and a completely organic App Store boycott.
That one is fascinating.
It really is. And finally, we will break down some crucial corporate earnings, including a brutal 11% stock drop for a sneaker brand that just posted record-breaking historical numbers.
It is a packed board today, and as we move through these pillars, you'll see that all of these threads are far more intertwined than they might appear on the surface.
Okay, let's unpack this, starting with the geopolitical situation and the global market shockwave. According to the reporting from Yahoo Finance and CNBC, the timeline over the last 72 hours has been incredibly fast-moving.
Blistering pace.
Right. So the core event driving the global markets right now is that joint U.S. and Israeli strikes have killed Iran's supreme leader, Ayatollah Ali Khamenei. And in response to this, Iran has launched heavy retaliatory strikes. They're utilizing waves of drones and missiles across the region.
And the scope of that is huge.
Yeah, the reporting indicates they have hit targets in at least 9 different countries. They're specifically targeting major oil and gas infrastructure, and they have struck the U.S. Embassy in Riyadh. President Donald Trump has publicly stated that the U.S. will do whatever it takes, which that signals to the markets that this military campaign is set to intensify.
Definitely.
He actually projected that the war could last 4 to 5 weeks, though he readily acknowledged it could extend even longer.
What's fascinating here is how immediately this physical kinetic conflict translates into a global energy and supply chain crisis. The sources show us exactly how this transmission mechanism works in real time. Iran has reportedly closed the Strait of Hormuz.
Which is a massive bottleneck.
Exactly. To give you a sense of why that single data point is shaking the markets, more than 14 million barrels of oil per day transited through that strait on average last year.
Wow.
That accounts for nearly a third of the world's overall seaborne oil exports. It is an irreplaceable choke point for the global economy, and the sudden closure of it forces an immediate repricing of global logistics.
And when we look at those logistics, the cost of trying to navigate around this or even through this is just staggering. What does the data from the Baltic Exchange look like for vessels trying to make that run right now?
It is almost difficult to comprehend the scale of the spike. The Baltic Exchange data cited by Bloomberg highlights that the cost of hauling crude oil from the Middle East to China has skyrocketed to a record $424,000
a day.
That is $424,000 for a single day of freight.
That's just unbelievable.
And to add to the supply side pressure, Qatar has had to halt its LNG production at the world's largest export facility due to drone attacks. That single shutdown sent European gas prices surging more than 50%.
A 50% spike in European gas prices almost instantly. So, with the physical supply chain effectively choked like that, how violently is that spilling over to the broader oil markets today?
We saw an immediate and aggressive repricing. Brent crude jumped about 6%, pushing above $80 a barrel, and West Texas Intermediate rose more than 5%.
Okay.
But the secondary effect is the sheer friction being added to global trade. Container shipping giants like Maersk are completely suspending all vessel crossings in the Strait of Hormuz until further notice.
They're just avoiding it entirely.
Right, they are now rerouting vessels around the southern tip of Africa. So if you model out Trump's projection of a 4 to 5 week conflict, rerouting around Africa for a month adds massive delays and massive costs. And that will inevitably trickle down into the inflation models central banks use to set rates.
Which naturally brings us to the broader equities market. With an energy shock of this magnitude, coupled with the uncertainty of a widening theater of war, you are seeing a massive risk-off environment take hold.
Huge sell-offs.
Yeah, Japan's Nikkei 225 dropped just over 3%, and Hong Kong's Hang Seng Index was down 1.25%. But, in stark contrast, defense stocks surged. Some names rising over 20% as investors attempt to price in sustained, long-term military spending.
Right, the capital's flowing where the government contracts are expected to go.
Exactly. And then we have to look at the commodities acting as safe havens.
The movement in gold was historic. The price for a troy ounce shot above $5,400 overnight.
Over 5,400.
Yes, before settling back into the $5,300 range. Certified financial planner Barry Glassman noted in CNBC's coverage that while gold is doing exactly what it is supposed to do in this environment, global energy and defense stocks are acting as secondary geopolitical hedges right now.
Interesting.
Yeah, institutional money is scrambling to find the specific sectors of the market that won't just hold up, but will actively benefit from this specific type of volatility.
That brings up an alternative perspective that CNBC's Jim Cramer highlighted, which I think is super important for our listeners looking at domestic portfolios.
What did he note?
Well, Cramer pointed out that the U.S. stock market actually rebounded slightly late in the session. The S&P 500 inched up, and the NASDAQ composite finished higher.
Contradicting the global trend.
Right. He argued that the geopolitical turmoil isn't automatically translating into deep economic panic in the U.S. specifically, because the American economy is shielded by domestic energy resources that are, in his words, much more bountiful than they used to be.
That's a great point.
So his thesis is that the U.S. simply isn't as structurally dependent on Middle Eastern oil as it was during the shocks of the 70s or 80s.
That is a vital macroeconomic distinction. The U.S. market might be somewhat insulated on the energy front, but the situation on the ground in the Gulf is incredibly tense, and the diplomatic back channels are working in absolute overdrive to contain this.
Because nobody wants this to drag out.
It's exactly. Bloomberg's reporting brings us behind the scenes, noting that the UAE and Qatar are privately lobbying allies to help them persuade President Trump to find an off-ramp to keep U.S. military operations against Iran short.
The underlying fear for those Gulf states is that they get drawn into a protracted conflict they desperately want to avoid, putting their own infrastructure in the crosshairs.
Their bases and infrastructure are highly exposed to retaliation right now. Bloomberg shared a critical defense statistic from an internal Qatari assessment that really puts this into perspective. Qatar's stock of Patriot interceptor missiles will only last 4 days at the current rate of use.
Just 4 days of interceptor.
4 days. That illustrates the sheer intensity of the incoming fire. Because drone swarms have emerged as a much greater asymmetric threat than traditional ballistic missiles, these nations are urgently requesting assistance.
They need air defense immediately.
Italy's defense minister even told lawmakers they received direct requests for anti-drone and anti-aircraft help from the Gulf.
Though it is definitely worth noting the very stark difference between public posturing and private negotiations here. The UAE's Ministry of Foreign Affairs released a statement completely rejecting the Bloomberg report. They called it false and misleading, insisting their defense capabilities remain steadfast.
And Qatar did the same.
Yeah, Qatar released a similar statement affirming their operational readiness. But the market is clearly ignoring the PR and pricing in the vulnerability that the Bloomberg reporting suggests.
It is the ultimate fog of war scenario. Public reassurances are absolutely necessary for domestic stability in those nations, but the rapid deployment of resources and the frantic back-channel lobbying tell the true story of how seriously the region is taking the threat of infrastructure damage.
Here's where it gets really interesting, though. Let's pivot from the physical battlefield in the Middle East to the digital one in Silicon Valley.
Let's do it.
Because this geopolitical crisis just collided head-on with the artificial intelligence industry in a way that I don't think anyone modeled out, we are looking at a massive tech fallout involving OpenAI, Anthropic, and the Pentagon.
The sequence of events here almost feels like a corporate thriller. It centers around a $200 million deal struck between OpenAI and the U.S. Department of Defense. But the sheer velocity and timing of this procurement is what caused an absolute uproar across the tech sector.
The timing is everything here. According to the reporting, OpenAI signed this $200 million contract with the Pentagon just hours after President Trump banned federal agencies from using tools from a rival AI company, Anthropic.
Just hours.
And, making the optics even more intense, OpenAI signed the deal just hours before Washington carried out the strikes on Iran. Securing a government contract of that size in a matter of hours is just unprecedented.
To understand why the DoD moved so fast, we have to look at what occurred with Anthropic. Anthropic was actually the first AI lab to deploy its models across the Defense Department's classified network last year.
Right, they had the early lead.
They did.
Oh.
But recently, talks between Anthropic and Washington over safety guarantees completely broke down. Anthropic, which heavily markets itself as a safety-first company, sought binding guarantees that its tools wouldn't be used for domestic surveillance or to operate autonomous weapons without human control.
Which the Pentagon clearly balked at.
When those talks collapsed over the terms, Defense Secretary Pete Hegseth designated Anthropic a supply chain threat.
So Anthropic gets sidelined by the Pentagon, and OpenAI immediately swoops in to take the contract, which, optically, caused an absolute earthquake in the tech community. How did Sam Altman address the massive pushback they received for moving so fast on a defense deal on the eve of a military conflict?
Altman had to make a very public admission to try and manage the fallout. He posted that the company was genuinely trying to de-escalate things and avoid a worse outcome, but he flat out admitted that rushing the deal looked, quote, opportunistic and sloppy.
That's a pretty candid admission.
He had to be candid. He also revealed the contractual safeguards OpenAI demanded to try and quiet the internal and external backlash. They amended the contract to explicitly state that the AI systems shall not be intentionally used for domestic surveillance of U.S. persons.
Okay, that's a key safeguard.
Crucially, the Pentagon also affirmed that OpenAI's tools will not be used by intelligence agencies like the NSA. Any service to those types of agencies would require a totally separate, follow-on modification to the contract.
Which brings us to the consumer market, which actually flexed its muscles here in a major way. The user backlash over OpenAI signing this Pentagon deal led to a massive organic boycott.
Users were furious.
Users started ditching ChatGPT, and the sources report that Anthropic's Claude actually overtook ChatGPT in the App Store as a direct result. The insight here is that corporate ethics are now acting as a tangible market force. We are entering an era where user boycotts happen in hours, meaning a company's geopolitical alignment is now a direct metric of its consumer market share.
That is a staggering shift in consumer behavior driven purely by optics. It shows that in the highly competitive AI space, user loyalty is heavily tied to the perceived safety and alignment of the company building the models. Consumers are treating these chatbots almost like political entities, and they will migrate platforms overnight if a company violates their ethical expectations.
And the tech fallout doesn't stop at AI chatbots. There are very tangible tech casualties happening on ground in the Middle East right now. The Reuters report highlighted that Chinese autonomous driving firm WeRide has completely suspended its robotaxi fleet in Dubai.
Which makes perfect sense when you consider the operating environment. These Chinese robotaxi firms have flocked to the Gulf recently because of friendly regulations and high consumer demand. It was a massive expansion market for them. But a widening war makes operating experimental autonomous vehicles incredibly dangerous. While WeRide paused in Dubai, they noted they are keeping operations going in Abu Dhabi and Riyadh, but with all employees working from home. Meanwhile, competitors like Baidu, with their Apollo Go service, and Pony.ai, are closely monitoring the situation but haven't pulled the plug yet.
And in a strange twist of corporate partnerships, while all this is happening, Uber is actually rolling out Baidu's self-driving taxis for ride-hailing in Dubai. So the technology deployment is fracturing depending on the specific city and the specific corporate risk tolerance of these massive tech firms.
It perfectly illustrates how an escalating kinetic war, halfway across the world, instantly disrupts the rollout of cutting-edge, futuristic technology. The supply chain of innovation is just as fragile as the supply chain of crude oil, and we are seeing companies make vastly different gambles on how to manage that risk.
Speaking of gambles and corporate realities, let's shift gears to our final pillar, corporate earnings and future bets. Let's look at the Swiss sneaker maker On Holding, which trades under the ticker ONOM.
This is a fascinating case study in market psychology and the sheer brutality of Wall Street expectations.
It really is.
On Holding reported their full year 2025 earnings, and by almost any metric looking backward, they crushed it. They sell premium-priced athletic shoes and apparel, and they were successfully grabbing real market share from legacy giants like Nike and Adidas.
They're everywhere now.
In the fourth quarter, their sales jumped a massive 30.6%. And for the full year, their sales surpassed 3 billion Swiss francs for the very first time in company history.
So basically, On Holding ran a perfect marathon, but Wall Street is punishing them because they didn't do it while juggling flaming porches.
Exactly.
Because despite that record year, the stock crashed. It
Yeah.
fell 11% in pre-market trading.
That is the perfect analogy. If we connect this to the bigger picture, it is a brutal reminder of the penalty for pricing to perfection. On Holding crushed their historicals, but Wall Street threw a fit because their forward guidance missed the whisper numbers. They provided guidance for 2026, estimating that net sales would grow by at least 23%, hitting roughly 3.44 billion francs.
23% forward growth is huge for a footwear brand.
It is huge, but sell-side analysts had built their models expecting sales closer to 3.7 billion francs for the year. The stock was trading at a multiple that demanded absolute perfection.
So any slight miss on guidance is fatal.
When the guidance was merely great instead of unbelievable, the market punished them. It shows how unforgiving institutional investors are right now. Stealing market share isn't enough if you don't clear the sky-high hurdles analysts have set for your future growth.
That is a harsh lesson in earnings mechanics. Now, looking a bit further into the future of tech, we got some amazing insights out of the Mobile World Congress in Barcelona regarding where hardware is heading.
This was big news.
Qualcomm CEO Cristiano Amon made a bold statement, saying that robotics will reach massive scale and become a much larger opportunity for the company within just 2 years.
Amon's comments tie perfectly into the AI discussion we were having earlier. The bottleneck for robotics hasn't necessarily been the physical hardware. It's been the processing power required at the edge, the brain of the robot.
Right, the local compute.
Qualcomm recently launched a processor called the Dragon Wing, specifically designed for robotics. Amon explained that because of advances in AI models, what they're now calling physical AI robots can finally understand the world around them and act autonomously without being entirely dependent on cloud computing.
Physical AI. That is a great term for the next wave of this tech.
It really captures the paradigm shift. And it's not just Qualcomm making this massive bet. Amon echoed sentiments from NVIDIA CEO Jensen Huang, who stated last year that robotics is one of NVIDIA's primary potential sources of massive future growth.
Heavy hitters agreeing on the same thesis.
When you have the CEOs of both Qualcomm and NVIDIA pointing at the exact same hardware sector and declaring it the next trillion-dollar market, investors need to pay very close attention to who is supplying those components.
We will definitely be tracking the physical AI rollout. All right, before we wrap up, let's run through a quick-fire list of the major after-hours market movers from the Yahoo Finance and CNBC coverage.
Let's do it.
MongoDB took an absolute beating, plunging 23% after they issued weak first-quarter guidance. On the flip side, PlugPair jumped over 7% after reporting much stronger than expected sales for their fourth quarter. The fintech company Dave popped 8% on raised full-year guidance, and Tidewater, an offshore energy service vessel provider, advanced 5% after also raising their full-year revenue outlook.
And as we move through the rest of the week, the primary focal points for the markets, outside of the geopolitical headlines, will be the retail sector.
Consumer spending.
Right. We are expecting crucial earnings reports from Target today and wholesale giant Costco later in the week. Those reports will give us a very clear read on the health of the everyday consumer amidst all this global uncertainty and inflation pressure.
So what does this all mean for you? We've covered a dizzying amount of ground today, from missile strikes to shoe sales to physical AI processors. But the core takeaway is how deeply connected your daily life is to these massive macro headlines.
More connected than ever.
The closure of a shipping lane thousands of miles away dictates the price you pay at the gas pump tomorrow. A hyper-fast procurement dispute over a defense contract between the Pentagon and Silicon Valley literally alters the ranking of the AI chatbot you might download to help write an email.
This raises an important question that builds on everything we've just discussed. We spent a lot of time today talking about the trillion-dollar growth projections for physical AI, robotics, and edge computing. But if a single geopolitical event can entirely rewrite a $200 million AI defense contract overnight and force autonomous vehicles off the streets of Dubai, we have to ask how much of the tech sector's massive forward valuation is entirely at the mercy of foreign policy.
That is the million-dollar question.
If the hardware supply chains required for the physical AI revolution run right through these active conflict zones, the market might be severely underpricing the fragility of tomorrow's biggest innovations. We often separate the physical world from the digital one, but this week proves they are entirely intertwined. A geopolitical conflict halfway across the world didn't just rattle the stock market. It immediately crowned a new winner in the iOS App Store and paused the deployment of autonomous vehicles in the desert. In 2026, there is no such thing as an isolated event.
That is a phenomenal question to leave off on, and something we will definitely be monitoring as these physical and digital supply chains continue to collide. Thank you so much for joining us for this deep dive into the sources, and we'll see you all tomorrow morning with new headlines from major financial magazines.